Greetings, everybody. This is Jeff Scott. It is actually late at night on Saturday, about 11 p.m. I thought I'd get this done now. Hope you're enjoying your 4th of July weekend. It's been beautiful, except for a little bit of rain down here in South Florida. Hopefully I get to play some golf tomorrow, which is why I'm doing this now. Last week, I was very bullish. I said we'll hit new highs, showed you the strong seasonality. Well, we got the new highs. Now what? Friday certainly put a little bit of damper on the week with the surprise to the upside on the employment numbers and sort of the eradication of a lot of people's expectations of a 50 basis point cut by the Fed. I'm not surprised at all. I thought 25 basis points was all we're going to get. I hope we still get that, because if not, I think the market will sell off hard. More to follow on those comments. For those that are new, I start with a PowerPoint presentation. No, I'm not trying to sell you a product, but I use the PowerPoint slides to cover a bunch of information that I look at on a daily basis to get a sense of what the market is doing. As always, this is for educational purposes only. I'm a doctor, not a broker. I have no licenses to manage yours or anybody else's money except for my own. I'm independent. I have paid for the tools that I use, and therefore I'm honest and I say what I think. Sometimes I should have filters, I suspect, but no one pays me to say good or bad things about their programs. And trading involves risk, and you alone are solely responsible for any investment decisions you make. How are you doing compared to the indices? I'll show you mine, maybe some today, but I'll certainly talk about it tomorrow when I do a review. On the left are the indexes year to date. Those are impressive. I'll just give you a little spoiler alert. Take the highest number and multiply it by over 2, and you'll see where I'm at on my account year to date, on my trading account. Join me for a webinar on July 8th, which is, I guess, Monday. I'll talk about how I outperform the indices, trading pullbacks while keeping a full-time job. I'll quickly talk about my top-down approach, introduce you to smart groups if you don't know what they are, show you my favorite pattern that I trade over and over and over again, how I trade that pattern, stocks and options, and how I manage my money. Here is a URL, https://tinyurl.com/y2p32hsc. That should get you to the order form to join. Again, I have nothing to sell you, so you'll hear a little bit about what my motivation is for doing these, but other than that, it's pure talking about the markets. I basically define or call how I trade, or how I teach people to trade, to be your own guru. I've learned from the best. I started with Cancelim, improved by Ian Woodward. Ron Brown went from the audience to a partner of Ian. Ron and I often find the same stocks, but we get there totally differently. He's a big VSA advocate. Gil Morales and Chris Kacher, ex-O'Neill money managers, their pocket pivots and Bible gap ups and how you trade them are an important part of what I do. I learned a lot from George Lee, my trading buddy from the Pacific Northwest, and hopefully I'll hear from him in the next couple of days about whether or not he wants to do a meeting in November, because that will impact on whether I do one down here and the date of such program. What else do I have to tell you? This is John Person. You'll hear his name mentioned frequently when I talk, when I trade. He really taught me how to take the rules, the background, and then how to actually act and how to make money with trading. Van Tharp, the king of money management, and Cigar down here from Superior Profit. And congrats to those of you who actually read my email and signed up for your free trials, which turns out to a year free of their programs. I had a lot of people reach out to me. I think people must have thought there was a gimmick. It was probably the best deal I've ever seen of a freebie, 3 years worth of a product. I own a lot of programs. I need TradeStation or Thinkorswim. I need HGSI and EdgeRater. The rest are helpful, but not necessarily necessary for me to make money. Here's the website address for Cigars products, and those are some of the other things I've used. Here's the website for HGSI. Just to say once again, I don't get paid anything if you buy the product. I don't get a commission. In fact, I just paid a big check to them to put some indicators for me into the program as they're starting a new business-to-business venture, which will allow third parties to create their own indicator packages for either for themselves, which is mine is for now, or for use as a follow-on offering. The free 30-day trial doesn't require credit cards, and under investing strategies, you'll see hundreds of movies by me, Ron Brown, and others. So I always like to go, where are we? I certainly don't think we're down here at this green circle that we're about to start a new run. The question is, how far do we have of a run that's been going on now for a number of weeks? And are we topping as I thought we were and going to roll over? Or do we have another or continued Fed frenzy to higher highs? I have to believe there's more risk to the downside than upside here, but I also got to play the market that I have. So we'll talk more about why I think there's some risk in this market. I pretty much was living over here this week, buying stocks, buying calls, selling puts. I don't do covered calls when I'm this bullish, but at the end of the week, I started selling calls against a lot of my positions, which will help to mitigate some pullbacks in the market. I do a lot of bull put spreads. To me, it's like getting free money. When stocks go up, you sold the expensive put and bought a cheap put to protect your margin account, and they usually become worth zero and you keep the premium. I'll probably start raising some cash this week, and I'll show you why as we go forward. Sector review. Friday was an interesting day. We ended up down 32 points on the NASDAQ and 69 or so on the Dow futures, and the E-minis were down less than 10. But we were down 3 times that at some point. And I actually thought I was going to finish the day positive, as I started off pretty negative, but as the day went on, my account got back to neutral. I lost a little bit in the last 10 or 15 minutes, but it was a great week. I'm sure it was a great week for you as well. Let's just take a quick look at the major markets in Thinkorswim. It's easier to see them. I said we'd get new highs was my bet, and you'll see on the futures how right I was. Not that it took a rocket scientist. Here we have our lows of the year back in January, and we just hit a high intraday on Friday of the futures, but we have a red bar. So that's a red candle high, and that could be indicative of a reversal. We'll see. On the other hand, it's kind of like a hammer with a long tail below, but not much above. So we'll see. Those are, to me, are sort of opposite signals. On the NASDAQ, tell you the same exact thing. Finally hit a new high. On the Dow futures, the same thing. So I think it's really interesting that on each of these, we hit a annual high this week, and but also finished with a red candle. Now, what we didn't hit an all-time high on was the Russell, which actually had an okay week since here was on Friday, so it closed up quite a bit on the week. But it pulled back from its highs that it set on Tuesday. It'd be nice to see the Russell lead instead of lag. The VIX, no surprise, has come down into its pattern. Tried to go up on Friday, and as the market started improving, the VIX came back down. But I do think we're at a point where the VIX is something to watch. And the dollar, which had been falling sharply, and set up a nice rally in gold and other metals, the dollar popped, and I think it popped on strength in the economy that we saw with the monthly unemployment numbers, or as John Person calls them, the monthly unenjoyment numbers. So that's what I see on the dailies. If I look at the weeklies, and I don't need to go in that much detail here, we'll look at the cash markets in a few minutes. You could see how the top 3 indexes, the E-minis, and so the S&P futures, the NASDAQ futures, the Dow futures, is hitting new weekly highs. We still got a ways to go On the Dow, each of these are in weekly buy signal still. The VIX struggling to get above the 200, and the dollar sort of still in a sideways motion, although it did feel for a few days it was dropping, sort of from the high of the channel down to the low of the channel. Now, the rates firmed. You can't see it real well, but they actually have a little upturn that came on Friday on the jobs number strength. So rising rates might be good for banks, regional banks, and insurers, and clearly you'll see lots of those when I talk about the stocks that were working. They should be bad for REITs, MLPs, utilities, dividend payers, and home builders. We're still low rates by any means. Just for example, this line here is a line I put in probably a decade ago. As long as we're above that line, I'm not worried about the economy. And if we stay in between the two lines, I'm not worried about the rates getting too tight. So we have low rates, period. Now, I'm not sure how well you can see it, but the 210 Treasury yield spread, 10-year, 2-year, is tracking up a little bit. So it's getting further away from inversion, which has to be good. The AD lines, which are hard to break out here in white, are at all-time highs. And if you look at the NYSE, you can see that here, the AD line at all-time highs, and it's carrying all the bullish ETFs with it. The only thing that turned down this week, and again, no shocker with rates perhaps at minimum firming, maybe going up a tad, was the TLT, the bonds. Now, here's where I start to get nervous. Going back since 2005, I drew this trend line as it seemed like the market would get less and less extended, or a percentage of stocks greater than their 200-day moving average, before the market would reverse. And this line held for quite some time. It broke here and here, but for the most part, it reverses at this area, and the market usually pulls back with it. Well, what happened on Friday? We hit the reversal zone. Stocks above the 40, certainly not at the highest they've been, but an area that has often been an area of reversal. But more important is the T2121, the 3-month or 12-week new high, new low. We have spiked above extreme levels. There has not been a time in 20 years where this has not led to, at best, a sideways move in the market or some sector rotation, and typically some pullback. So I'm expecting the market to, I'm expecting it at best to be flat over the next few sessions. That could be enough to ease this, but I do think we are getting to a point where the extension of the markets to a point where a reversal is probably getting, not sure imminent, but closer. If I look at the daily McClellan, clearly higher highs in the S&P, but not on the summation index and not on the oscillator. Same thing on the weekly. So we've got divergences there, and that's something that might be concerning. The buckets, 82% of stocks in the S&P 1500 are above the midline of their Bollinger Bands. Not an extreme, but shows you the level of bullishness in the market. And what's also not a level of extreme is the number of stocks above their Bollinger Bands. But notice so few stocks are at the lower part, and almost none are below their lower bands. So not a signal yet, but showing you that we're getting more and more overbought. There was no Hindenburg this week, not a surprise. We have lots of new highs, not a lot of new lows. Market tone, we look at the Woody indicator, which is where my arrowhead is, this third set over here, all green, that's great. Yet we have more and more yellow popping up in these sectors, suggesting both sector rotation and maybe some weakening. I like to look at the big stocks, and that's the canaries in the coal mine, as you can see here. And interestingly, not really a big breakout yet. It has to take out this highs here back in May, but we did break above resistance, perhaps led by some firming in Google and Tesla. And if I look at the index that I put together in March, which was leaders at the time, it still has not broken, and frankly, it looks like it wants to run again. Know your news and your earnings. In red, I think, are the big deals. We have Powell speaking on Tuesday. Wednesday, and Thursday. We got a CPI and jobless claims on Thursday. We've got some energy on Wednesday, and we've got the PPI on Friday. There's a number of other Fed heads speaking. I guess they have sort of a quiet period up until the meetings, and not sure exactly when it expired, but obviously they're not in a quiet period this week. It's time for earnings season to start to pick up. I think next week and the following week will be much more active, but you need to know when your stock's earnings are, and here's some of the more widely held. I think Delta must have pre-announced, it says here, before the open. Market thoughts. Strong employment measures as announced Friday tempered the enthusiasm for a 50 basis point cut and led the markets lower Friday, although the week ended significantly higher. Major indices did hit new highs as G20 comments, especially Xi and Trump, led to expected melt-up that I predicted last week and is setting a strong seasonality in a holiday. News likely to drive markets again this week as markets eagerly await the Fed minutes on Wednesday. While Powell speaks midweek multiple times, folks will continue to listen for some affirmation that a Fed cut still looms at the end of July, whether or not, or even if only 25 basis points. The dollar firmed and the rates rose on a setting of positive economic news Friday. This led to a pullback in metals while banks led. It'll be interesting to see how this is digested and whether some of the economic enthusiasm wavers this week. I did listen to a podcast by Peter Schiff, he's a perma-bear, who thinks the economy is always imploding. But he gave a case of why people misinterpreted it, and it was a lot of college kids gone to work. So we'll see. I remain long, but risk feels like it might be increasing again. We're certainly getting overbought. And considering the 12 week new high, new low ratio extreme reading, it might be a good time to take some profits off early in the week. Again, the markets have done quite well, and I'll try and put this URL, if I remember, in the YouTube column as well as in the email I send out. And if you have HGSI, you'll get, sometimes it gets annoying. Every time you update, you'll pop up a web page that gives you a place to click if you'd like to come and join me. I will do a lot more teaching during that webinar. There'll be interaction because you'll be live, and I'll show you how I find great trades by looking at the right edge of the chart, and once I find them, how I manage them. So let's go and take a quick top-down review, and I'll get to bed, and hopefully this will load okay, and tomorrow I'll get to play some golf. So I do the same thing every time. I'll start with TradeStation very quickly and look at my major market. And let's take a look. Again, we know Friday was a soft day, but you can see how we had a big run-up above the envelope. We have a buy signal that came in this week. I think I said we'd see one right away during the week, which we did. Weekly buy, monthly buy. A blue bar is a neutral bar, a green bar is a bullish bar, a red bar is a bearish bar. On a neutral bar, you could be long or short. On a green bar, you should not go short. On a red bar, you should not go long. The weekly and the monthly are green, so that's pretty strong here. The fact we're above the outer envelope tempers me a little bit. The fact that we've got these red dots occurring on the weekly suggests a slowing down of a market with some divergences, but they may occur for numerous weeks before the market sells off. I come down here. This is the part that has me a little bit concerned, is my high jump bar is at 97. Now 97 is pretty darn big, and it tells me that we probably can't get a whole lot more extended before this market pulls back. And no shocker, my weekly bongo and my daily bongo are green. That's the E-mini. What about the Dow futures? 93.28, otherwise they look pretty much the same. The NASDAQ futures, 93.22, otherwise everything looks the same. The laggards, the Russell futures, and you can see that they're at 90, so they're extended on their little run up. All the markets look very bullish, but they also look like they're at a point where reversals are probably not too far away. Now, you might be wondering, how do you get these indicators that I have? At my live meetings, I usually include them at the time for the people who are attending and paid to attend. The high jump is one of my secret weapons, and it's an adaptation of Ian's, but I set it to a percentage of the highest high jump over the last X. In this case, it says 200 bars, and that tells me there's been no, this is the 90th percentile. That E-minis is the 97. That's a pretty robust number. Now let's drop out of this. Let's take a look at the cash markets, not the futures. Since most of you, and myself included, when I say you, trade mostly stocks. Let's just go into my modify user groups. Here, that's not what I want to do. I wanted to open this up, find the first one, Major Markets Plus. Let's look at a top-down view, and we can see on the week, or at week end, small caps and mid caps, NASDAQ, small caps are leading. Innovator IBD 50 fund leading. So if you're a high growth stock investor like me, you had another good week last week. Should have had a couple in a row, frankly. What was trailing? Bonds, silver, gold. Now this biotech thing was sort of a surprise until you saw that Trump is tweeting about drug prices again. Easy to tweet, a lot harder to solve. That's the industry that I'm in. And let Congress complain, but frankly, you got to blame it on them, because in 2003, with the Medicare Modernization Act, Congress took away the ability of Congress to negotiate drug prices, even though Medicare is the largest purchaser of health care in the country. I'm not a big fan of Medicare for all, and I don't think it's going to be that easy, but I usually keep my mouth shut here and don't want to make this a political statement. So, here is the S&P 500, and the cool thing about this week was we popped out of my box. Now, we had a false breakdown here in the beginning of June, and another V-bottom and a rapid move up to new highs. In fact, if we want to look at where we closed on that, just to give you a sense, from the low on that spinning top until the high here, 9.7% move. That's a pretty, let me try that again. There. Yep. 9.7% move. We are now back up to near our all-time highs. We gave up a little bit on Friday, but frankly, you got to be impressed that, I don't want that square there. Oh, that's what I did. Dummy. You kill that. All right, let me try this one more time. (9.8%). We broke, so Friday we broke above. We gave back a little bit on Friday here. Really not a bearish looking day, closing with inside the previous spar. To me, it's a consolidation day. Let's see if this line here holds. You hope that what was resistance once, 2, 3 times now becomes support. We'll see over time whether that's true. If I look at the Dow, it should look very similar. And all I got to do is draw the box. I like drawing boxes. You can probably tell, not that it's a thing about elementary school. Go down here. So I kind of liked it better here. And you could see we broke above the box here, the box being resistance. If we look at the NASDAQ, not quite above the box, but within range of the box. And the Russell is lower in its basing period. But all of these have to be considered bullish. And would point to higher highs ahead. The dollar sold off a little bit on futures on Friday. Now, excuse me, let me back up. The dollar sold off about 10 days ago, but actually gapped up on Friday, but then gave up a little bit of the gain. So the dollar was up on Friday. Sorry for that confusion. I'm looking at a lot of different things here. The VIX is down in its pattern, but actually had a green candle low, which is a kind of sometimes can be a reversal signal or give you a hint. And now what do you do with gold? With dollar firming up, gold dropped, but it closed higher than its low, than its open rather, for a green candle. I probably would not let it get too far below the low of yesterday, but there is a chance, I believe, that gold may still go higher, and silver has pulled back further than gold. So, looking at this, stocks continue to look strong, and you'd still be bullish. It's some of those signals about exuberance and overbought that have me concerned, not the charts that I'm looking at. If I look at where are the leading industry groups, I'll hit the warehouse view, go up to the top. And if I look at two-day force, you'll see that I've got 65 groups to the positive, and I have 79 over a longer period of time of 5 days. If I look at two-day down, you'll see we're starting to see some groups to the downside. We now have 16. They'd been just one or two. If I look at over a longer period of time, it drops down to 7. There's some groups in here that are typical HGSI high growth groups. We've got steel, we got large pharma, we got base metals, integrated oils, exploration. So clearly there's some rotation occurring here. And as I said, there was a pretty loud Trump tweet that sort of killed large pharma, biotech, and specialty pharma, at least on Friday. But notice over 5 days, all these groups are positive, just showing some of the underlying strength in the market. I like in a bullish market to concentrate on the upside. So let's just take a look at a couple of these. We'll start with the airlines group, change to index group. And the one that comes to the top is Goal Linhouse. This is a South American airline that had a positive earnings number. Now, isn't it interesting? You had a move up with a kahuna on Friday, and a further on Thursday rather, or Wednesday as the case may be here, and then a further breakout on Friday. So you could have spotted this early. It's probably too far right now, and it's probably not something that I'd be going and chasing at this point. And it did have an official Bible gap up on Friday. The one I do like is Azul. Actually, this is Copa, sort of a cup, a handle, and now breaking out. This is probably buyable here. And then Azul, here's another one with a Bible gap up, but one that's not nearly as run as GOL. And I like that as well. It's got some great earnings per share growth coming in as well, if I remember correctly. Interesting that the U.S. airlines are further down, and the big one that's got some earnings coming out this week is Delta Airlines. And let's just take a look at that. Not as exciting as the South American Airlines, is it? All right. So there's probably between Copa and Azul, there's something to look at. Telecom carriers. Now, I've been extremely bullish for quite some time and remain bullish on AT&T. And part of the reason I'm bullish on AT&T is the fact that it pays close to a 6% dividend. Well, it was about 6.2, 6.3 a few weeks ago. But as it started to take off, it's obviously the price goes up, the yield goes down. Still think AT&T looks good here. Verizon, I think as a company, is not quite as good as AT&T. It's at 4.1% dividend, but it's sitting closer to a buy point. So if you don't want to chase AT&T, Verizon looks interesting. Then I got a bunch of secondary players in Telesat. You know, if I liked the story and I liked its fundamentals, I liked the setup here with a kahuna and a mobile breakout from a squeeze, although I wish it was above the 200. TIM, Great looking setup here. Had a JSBI, pocket pivot, a Kahuna, mobile breakout, gapped up above the 200, pays a 1% dividend. Vonage, again, I don't believe in the story, which perhaps that's a mistake, but it broke above the 200 sideways and is breaking out again with multiple Kahunas down there and a high close doji and John Person speak. We'll talk about that some tomorrow on the weekly. So there's plenty to like here on the telecoms. What about banks? A little bit tougher for me. They all look the same. What you see are a bunch of stocks. Well, this is actually probably the best of the bunch and made it to my buy list. It's already broken out. Mobile breakout squeeze, Kahuna. This is sort of my right edge that I look at. I like to see that. I see here it's got some growth in earnings coming, pays a small dividend. By the name, it must be a South American bank somewhere. BB&T, also breaking out here early on. SunTrust. So which one of these did you buy? That's the problem. SVB, further down the pattern. Credit Corp, starting to break out. PNC, breaking out. Sometimes I just chicken out and I just go with KRE, which would be a ETF for the regional banks. It pays a small dividend. And if the banks move up, this will move up with it, and you avoid some of the name risk around earnings and other challenges. Banks up both because of passing the government's stress test, which has allowed many of them to buy back shares and raise dividends, as well as a rising dollar and perhaps a hint of firmer interest rates. All right, sorry about that. It's allergy season here. Internet media, take a quick look there. I mentioned some firming in Alphabet or Google. Yeah, it's a loose chart, pull back into the 50. Maybe this is the time it goes higher. I have a hard time chasing it. It doesn't have much earnings per share growth. I'll let smarter people follow Google. I've moved on beyond Alphabet. Snap is interesting here. It's a high base, ready to run again, mobile breakout squeeze, pocket pivot and Kahuna. The only problem I have with Snap is it's already run up from 12 to 15, which is about 25%. It does not have a positive earnings. From a pattern, I like it a lot. Maybe we'll talk about it tomorrow afternoon or Monday afternoon about how I might trade it. Twitter, no thank you. Facebook, showing that data concerns don't seem to bother it. Getting close to new high territory. I'm glad I only sold part of mine, not all of it. Tencent and IPO breaking above the 50. This could turn out to be a great buying opportunity, but I'd still like to see it take out its post-IPO highs before I get chasing it. Curate Retail Group. Don't know anything about what this group does. Digital commerce business, home shopping network type things. What I like about this is the Kahuna, my indicator firing, a mobile breakout from a squeeze. It's also got a weekly high close doji here. The reason why I didn't put this on my buy list is it's pretty far down on the pattern. And this here is my secret weapon. And maybe I'll talk more about it on Friday. And if Chris White, by any chance you're watching this, find a way to make this for me an edge rater. What this is looking at, here is the stock price on a weekly chart. Here is in red is the relative strength of the stock versus the S&P 500 here. Well, the S&P 500's up, the stock's down. Of course, the relative strength sucks. And then this is a moving average of that relative strength versus the S&P. And I find that stocks that are about to rally, when their weekly moving average weekly relative strength versus the S&P crosses above the moving average, starts to give me some interest and buying something that's beaten up. And you'll see plenty of those tomorrow. All right, that's the end of internet media. Exploration and production. Now you notice this was on the 5-day down, 2-day up. So with the OPEC meeting, there was a bit of a rally at week's end. You look at these again. Which ones of these stocks do you feel like owning? EOG, it's cheap. It had a high close doji, I guess. Are you ready to go in? Earnings per share growth sucks. Small dividend. I'm not, although maybe this is a great buying opportunity. Diamondback Energy looks a little bit better, about to pop above the 200-day moving average. Notice my secret weapon is dropped below its moving average. EQT, a shale producer in Pittsburgh. Concho, I'm going to find one of these that I like. Newsflash, I didn't find many that I like. So let's just look at XOP, which is the ETF. And you can see why I'm not thrilled. Now, interesting thing is it too is well below the blue line. So although this started to make it because it had some positive days, you can see the positive percents over one day, I'm not ready or convinced. Application software, there's a couple here that are on my pullback, waiting to run, need a signal. This is one. Twilio has been a great stock. It keeps pulling back to the 50-day moving average, and then it moves up. And it's sitting right above the 50-day moving average. Had a mobile breakout and a squeeze on Friday. I would love to buy more of this. I have a position already, but I need to see some more momentum coming in. Notice the demand to supply is 3.9. That's high, showing that it's under accumulation. MongoDB, another similar story. Buying at the 50 has been a good thing in the past, but when you don't need something that's going to skate around it for weeks, you want to find it when it's lifting. And I need to see more momentum, so I'll be watching that. Viva has already moved. Great story. Expensive. So this chart I liked. I liked it because look at that right edge. Green, green there. So my bongos are green. A mobile breakout from a squeeze. My indicator fired. A big pocket pivot and a kahuna. So something's going on here. It's got great earnings per share growth. There was some bad news about losing a customer, which caused it to fall from 45 down to 25. Probably worth doing a little research because that one looks like it wants to go higher. Talk about buying stocks on pullbacks to the 50. Paycom is one that I've been in and out of. Unfortunately, I've been out of for a little while. I can't buy it here. I got to wait for it to come back to the 50. All right. Specialty apparel. Interesting. TJ Maxx. All right. Here's a stock pull back to the 50. Looks like it's getting ready to run. All right. That's kind of interesting. L Brands. I've got my crossover here. It's the first time we've been above since late 18. This is the kind of stock where a break above the 200-day with momentum might be interesting. Notice 89% of this group of apparel have a buy signal. Apparel is moving. Abercrombie & Fitch, not yet, for my taste. Foot Locker. Burlington has been a leader. Pull back a little bit. Looks like it wants to run again. Similar with Ross Stores. Number 8, infrastructure software. Symantec is a potential takeover candidate. It's already popped on speculation. Hard to chase this at this point. They're talking about $28 as the buyout price if it happens. Oracle, nice lower left, upper right, not really actionable in my opinion here. ServiceNow, you want to pick it up when it pulls back to the 50. It started to run already. ETA, Palo Alto. Splunk's got a weekly high close doji, broke above the 50. Don't like its earnings per share growth, but that's interesting looking as well. This is what I do. I go through the top 10 groups every night. Packaged foods, clearly a defensive play. Let's take a look at what we got. Kellogg's, nah. Brazilian foods, well, it's breaking out to new highs. Doesn't have much in the way of earnings, but certainly a consumer staple defensive play. Top of the high jump, so I probably wouldn't touch that. Not my favorite group here on this consumer staples. Tyson's looks interesting. I know there was some word about a Fed review or Chinese review of chicken pricing, so it's gone sideways. It's gone sideways. You're building up some momentum. We'll see if it can break out from here. This is the kind of stock that I might say I wouldn't want to buy this until it breaks outside the box. Now, you can play the Darvas box and short it at the top and buy it at the bottom, but you got to be a lot faster trader than I am for that. Now, here's a stock, McCormick, that actually meets a lot of my criteria for a buyout, for a buy rather. You've got a very long base, broke out on Tuesday, Wednesday, and Friday, a big move out of a squeeze. 3 out of 5 days with a kahuna. At the breakout, you also had a pocket pivot and a Jeffrey buy. That looks interesting here. Not my favorite stock, but it looks to me like it wants to go higher. And then lastly, the REITs. Now, I wouldn't expect REITs to be doing well, especially with the rates potentially turning up. But some of these look good. There's a lot of different types of REITs. This is North Star Realty Europe Corp. NRE. Pull back to the 200, broke above the 50. Pocket pivot kahuna and a viable gap up. Pays a 3.6% dividend. Innovative Industrials, I'd like to see it break out of this range before I would touch it, but they actually own some acreage that does marijuana as a REIT. American Towers, they're going to be a big winner of the 5G, pull back into the 50. Show me some momentum, take out this PSA RDOT, that looks interesting. And Crown Castle, similar. So what I've done is I've gone through the top 10 industry groups, and I've probably found some nice buys that I've mentioned. What I do as a trader is different. I now have a list that I call my buy watch list. And it's a pretty big one. There's 58 stocks in it. Actually, before I say that, let me go down here, and there are 56 stocks when I take out a couple of ETFs that I don't want in there. And let's just look at a little bit about the stocks I picked and see if there's anything here that you might want to be buying or at least looking at. So let's look at industry groups. We can see the application software. There are lots. Several of them I've already mentioned. REITs, there are several there that looked interesting that I've already mentioned. Specialty pharma. Amarin is one that I was an owner of in the past, and it hit my radar this week. And one thing I've learned is you go back in. So here's a stock, sideways. My signal fired here. Then I had a kahuna fire, a bobble gap up, mobile breakup from the squeeze. And I got back into Amarin back here. Despite a weekday on Friday, it was very positive. It's not about earnings as much as it is about a new drug coming to the market. There's my AT&T. Things that I wanted to call out that I may not have shown you yet. This was exciting. This is a cancer company. I would probably go look at this one. Horrible chart until Thursday and Friday. when it got an approval of a new drug. It's their first drug to be approved. Also had a weekly high close doji. What's interesting about it, it's got a market cap of $536 million. For a company with an approved drug, that's extremely small. I might see if it wants to settle out some after this red candle high, and then I might, if I wasn't under a restriction, I might consider buying Karyopharm. Most companies with an approved cancer drug trade considerably higher, more than a $500 million market cap. CyberArk's another long-term winner. Pullback sideways. This is the kind of stock we're going to talk about on Friday. Mobile breakout from a squeeze. My indicator fired back here. You got some kahunas. When do you buy this? We'll talk about when I buy them, how I find them, and then what trades I take and how do I manage the money on my program tomorrow afternoon. Just going down the list. A couple of these looked interesting to me. Very low in their pattern, but certainly setting a base. Mobile breakouts from a squeeze. This one has a 6.5% dividend. This is Janus, but I actually like Jeffrey more. Why do I like it more? Because it's broken above the 200. Pays 2.3. It's got some good earnings per share growth. And going down the list, one of my favorite patterns will be this FGL Holdings, FG. Why is it my favorite? Clear an uptrend from 6 to over 8. Loose but sideways. And then a couple kahunas, a mobile breakout from a squeeze and breaking out in a group that's been strong. Like that. And let's see if there's anything else to call out on this view. Another one like Sinclair Broadcasting, again, uptrend sideways. This thing's going to run again, and I'll be on board. So, how do I trade that many stocks? How do I manage that? Well, I don't trade all those stocks, of course not. But what I do is I put them into my TradeStation radar screen. And this is why I have to have TradeStation. I have the Q tools. I have my HGSI derivative tools. I know when earnings are coming. That's a freebie. And if I go far enough to the right, and I usually have a much bigger monitor. This is my monitor for doing the webinar. I've got all of John Persson signals. So I've got a number of ways. So I'll monitor my stocks that have made it to my buy watch list, and I'll look for changes in the radar screen. And those changes in the radar screen will get me interested. Once again, I have a list of stocks that are potential shorts. It's more to be a spotlight, or what would I call it, a light tower, to tell me that all of a sudden, if these stocks start moving down, that the market has changed. And that, for example, last week, those were my best performing stocks because this was a big rally off of pullbacks. So on that note, let me once again remind you that we have a webinar. I believe it's tomorrow, on Monday. And if you just update HGSI, whenever you update it, you're going to have this pop up. And I know George will make it go away Tuesday or Wednesday. Let's see if it pops up at all. And just to review, July 8th at 4 p.m. So that will be an unusual time to do one for me. Outperforming the indices with a full-time job. I'll put the link in here again. It'll be in the YouTube and in my handout. And you all have a wonderful Sunday and safe if you're driving home. Thanks, everybody, and good night.